Hi guys and welcome. On this video, we're going to discuss the different factors you should take into account when you're looking to consolidate your debt and how to choose the right lender for your needs. Let's start. If you have several debts that you have to pay off, you may want to look into debt consolidation. This process allows you to combine your current debts into one. Usually, this is a lower interest debt in the end too. So, if you owe $20,000 on 3 different credit cards, you consolidate those. If approved, you would get a $20,000 loan from your financial institution that you could pay off those debts with. Now, you only owe one lender $20,000 instead of owing 3 lenders. This generally gives you a lower interest rate and a lower payment overall. When considering a debt consolidation loan, here are the main factors you should take into account. 1. Interest rate. The first thing you need to know is the interest rate of your loan. When you're applying for any loan, it's one of the first things that you're going to ask about. Having great credit is going to help you with this process. You'll be able to get a better interest rate, and you'll have a better chance of getting approved at the same time. Now, when you start shopping around to different lenders, look at these ratings. They will tell you how much it's going to cost for you to get that particular loan. You'll want to look at APR and APY at the same time. This is going to help you figure out the best possible balance for your loan. After all, it's going to help you keep your costs down. 2. Fees. Next up are the fees that are associated with your debt consolidation. You could have a lot of fees associated with a loan, or you could have a few. They could be large or small. In fact, some of them you might not even notice because they're so small. But with everything from processing fees to origination fees and application fees, you could definitely be feed to death. Not to mention, if you end up late at any point, you could be charged penalties. And if those fees and penalties put you over your limit, you could be charged fees for that too. So, make sure that you're fully aware of what you're getting into and what types of fees you're going to be charged. 3. Terms. The terms mean how long you're going to have that loan for. What length of time do you have to pay everything back? Make sure you know exactly when the money is due, and also that you're being realistic about how much money you take out. If you take out too much, you may not be able to pay it back in time. You may end up with very large payments that you can't make throughout the loan term. How to increase chances of pre-approval. When your credit is not too high, you might face issues when applying for a debt consolidation loan. Here are a couple of ways that can help you to increase your chances to get the loan. Get multiple quotes. One of the first things you should do is get at least 3 quotes. That means you don't just go to your own lender. You also want to go to other places. And you want to use the lower of those quotes to get the offer you want at the place you want to go. But remember, lower interest is only part of it. You also want to look at terms, fees, and anything else associated with that new loan. Know what you need. Make sure you're prepared with everything you're going to need when it comes to apply. Which paperwork do you need to have to fill out the paperwork or turn into your lender? Having a list of all of those documents can make it easier for you to get through the process, and you can do it much faster this way as well. Slow down your applications. You want to slow down the speed at which you're getting those quotes. If you're applying for too many loans all at once, it looks like you're in financial trouble. That's going to look bad when it comes to your second or third application. Instead, you want to make sure that each loan company thinks they're the only one that you're going to. This improves your chances of getting approved. Don't just sit back and wait. Make sure you're asking questions. You want to know about different loan packages and different options. You want to know exactly what you're going to need to apply for the loan. Also, you want to know all of the details about that loan. So, make sure you ask questions of the lender. Find out how long the process will take, what you need, and anything else you can. The more you know, the faster everything else will go. Know your limitations. Talk to the lender before you start this process to find out more about what you could be eligible for. Don't try to get a loan for an amount that you're never going to get. If you know you have great credit history and a stellar score, you may be able to get a higher loan amount and better terms. If you know your credit history is spotty or your score is less than ideal, you should know what the options are for you. Getting a copy of your credit report ahead of time is a good way to make sure you're prepared. This will give you time to correct any mistakes on the report and to evaluate it. That way you know what you should be able to get and what you likely aren't able to. Also, Make sure that you know what you can afford to pay each month. If you can't afford to make the payments, you're going to be in even bigger trouble moving forward. Improve your score. Getting your credit score is actually simple, and you can do it for free on several websites. But once you know that score, you also want to work on improving it. Those with excellent credit, in the mid to high 700s or above, don't need to worry about increasing their score. In general, these scores are all treated the same by the lender. If you have a lower score, you could make a big impact on your offerings. If you're really close to breaking into the next bracket, this is even more important. For example, going from poor to good or good to very good. These classifications will help improve your loan offer. Making sure each of your bills are paid on time and lowering the amount of debt you currently have will help you to improve your score. So will getting rid of any false information that's currently on your report. You want to make sure you have everything up to date and accurate. Should I consolidate my debt? This is going to depend on a few different factors. In general, debt can be made a bit easier to handle by going with debt consolidation, but that's not always the case. Not everyone does better with this sort of approach. One payment per month. One of the biggest benefits you're going to have is only a single payment each month. This is compared to the large number of payments you could have with individual debts. This makes it easier to keep track over time. Easy to apply. If you do decide to apply for a consolidation loan, it's actually quite simple to do. Just about any financial institution handles them, and they will generally make it as simple as possible. You don't have a lot of paperwork, and you don't have to wait a long time to find out if you're approved. In fact, you may even be approved right then and there. This makes it a lot easier than other types of loans. Low interest. You're not guaranteed to get a low interest rate, and this will depend on your institution and your credit. But these types of loans generally have far lower credit than your credit cards or whatever type of debt you're trying to consolidate. You want to know that for sure, however. So make sure you compare your current rates with the rates you're being offered. That's especially true for credit card balance transfers with short intro periods. Risk of cycling debt. One of the biggest drawbacks and dangers with this type of loan is that you're clearing off all of your other debt and replacing it with a new debt. For some, this could actually put them in danger of getting right back into the same debt again. The problem is that you'll actually be in twice as much trouble. Home equity loans make this even more dangerous and could put you in a dire financial situation. Plus, you're at risk of losing your home, or you're going to have a larger mortgage than the home may be worth. Longer-term interest. You may pay less interest every month with a debt consolidation, but you could end up paying more overall depending on the type of loan you get. You could end up with a home equity loan that makes you pay more for your debt over that term of 30 or more years than you would otherwise. Alternatives to debt consolidation loan. Let's say you don't want to consolidate your loans. Then what can you do? Well, there are several different options. It all depends on what kind of debt-to-income ratio you have, as well as the credit score you have. For those who have a great credit score, you can make the most of consolidation. But there are other options. Balance transfer. If you don't want to or can't do a debt consolidation loan, but you do want to get all of your debt together, this is a great way to go. If you can get a 0% interest transfer, you will then transfer all of the debt to it. This means you can save money on interest over the life of the debt. Just keep in mind that you have to pay the debt off before the promo period ends. Keep in mind that you're going to be offered a short-term low interest rate. It might be 0% or it might be up to 5%, but it's only going to last for a certain amount of time. You want to make sure you know how to pay off everything within that period of time because it's going to save you money. By taking advantage of the no-interest portion of the exchange, you can join all of your debts together and get all of the same benefits as a consolidation loan. Home equity loan. This is also known as a second mortgage, and it's something important to consider. Now, with this type of loan, you're going to work with a lender and take out a loan, but your home is going to be the collateral for it. This can be a big risk for some people because you want to make sure you don't lose your house. You could end up losing your home and still being in a great deal of debt if you're not careful here. In order to get this type of loan, you generally need good credit and equity built into your home. You need to be able to get a good amount back. You also need to get a low interest rate on the loan. This is going to help you pay off as much as possible, though it's going to reduce your equity in your home. Now, make sure you're going to be able to make the payments on this type of loan. If you don't make those payments, you're going to end up in foreclosure. If you've ever seen this happen to someone else, you definitely know how horrible it can be. Still, this type of loan can be great because you have very low interest. You just need to make sure you know what you're trading in and what you're going to be risking overall. 401k loan. Now, this is not exactly the same as a traditional loan. With this, you're going to be the one who decides to take the money out, and you take whatever you want to an extent. From there, you have to pay the money back as quickly as you can. That's because you're taking retirement funds out of your account, and that costs a lot of money. You can only take up to 50% of the vested money, or $50,000. You get the lesser of those two, and then you'll have to pay it all back within a period of 5 years. If you don't pay it back in 5 years, you'll end up with even larger fees and fines. At least, unless you get an extension through your employer. These only apply for specific situations. For example, if you use it as a down payment on a house, you may be able to get an extension on paying back the money that you borrow. You'll also have an interest rate that has nothing to do with your overall credit score. On the bottom line, if you're currently struggling to figure out your next steps and you don't know how to take care of your debt, the first thing you should do is check your options. Talk with a financial provider about debt consolidation, and then take a closer look at the different ways it could work for you. That's it for now. On our website, you can find more posts and podcasts as well as calculators and other financial tools. Looking to consolidate your debt? We would love to know your thoughts, so feel free to share them with us in the comments below. I hope you enjoyed it, and don't forget to subscribe to our channel to get the best financial videos